Welcome everyone to News of the Money World. I am Darcy Ungaro. You are Rupert Carlyon. How are you, Rupert?
I'm very well. Glad to be back.
Same. It's good stuff. It's really good stuff.
The break's been far too long and there's just been way too much happening. So I've had to find real people to talk to.
Yeah, I'm sorry about that. That happens. We all have to deal with that, eh? And heaven forbid you end up talking to your children, right? So we can't have that.
No, exactly.
There's been a lot happening. It's almost like all the news events kind of waited until we weren't talking about it so that they could really get misbehaved, And so let's kind of pick up where we left off and start with the election. And under the election, we've got a few things that we should talk about. You've been fairly vocal around this topic of house prices and the new government. So do you want to unpack just what effect the National Party getting in will have on house prices?
Well, I think there's a couple of things, right? So first, I do firmly believe that the national government will help house prices and will probably drive house prices higher for three reasons. One is they are the interest deductibility coming off the landlords. I mean, it's a big cost and that will make a difference for the affordability of landlords to buy houses. Though I'm saying that, there was a dumb decision in the first place, right? It's just a standard business expense, so it never should have happened. I do firmly believe that allowing foreign buyers to kind of buy, that's going to create more demand. We are going to see people coming into this market that otherwise would not have been here. And so increased demand when we're short on supply, that has to push up prices. And the third thing is I think there's just going to be a little bit of a general optimism, how long that lasts for. But there is almost definitely going to be a bit of an optimism, which kind of is people have been wanting change for such a long time, that's going to drive prices further higher as well. And actually, one of the other things that I started to see a little bit talked about is the change to the planning rules. National have said that they're going to walk away from the intensification and the density rules that they agreed to last year. And I do have to believe that will slow down the development of new housing. Because it's going to take councils a lot longer to build infrastructure for greenfields. And actually, we know on a per square metre basis, it's about 30% cheaper to build intense high density housing than it is to build kind of freestanding housing as well. So there's a few reasons why I'm pretty happy to be a homeowner right now.
Okay, that's good. What do you think about the change to the bright line test rules then? Because there's obviously some speculation that could be quite bullish for property as well if they do bring it back down to 2 years from 10. In my mind, though, I would think, well, I wouldn't say that would necessarily be increasing pressure. That might actually increase pressure on the sell side, especially in a high interest rate environment. But what do you think?
So I've spoken to a few people that would be keen to get out of their properties if it weren't for the bright line test. So I think you're probably right in that if anything, it drives a little bit of the behaviour of adding supply into the market. But I think it's at the end of the day, I think we're talking very, very small biscuits around the edges here. What do we know? We know most landlords, you don't buy a house for the rental income, the 2% yield. Most of them are negatively geared. You're buying it for capital gains. And so I think, I don't see it changing a huge amount.
Okay. Subject to the next parts of what we talk about, right? So the next thing that we kind of have to unfold, because it is like, I think it's probably the thing that we're confronted with almost every day, and that's inflation. And inflation has tipped down, or the rate of increase, kind of like the rate of acceleration for all you physics buffs. It doesn't necessarily mean that we're slowing down. It just means that the prices aren't rising as fast, 5.6%.
100%.
So what are your thoughts there?
So look, I think that the news that we're seeing on inflation is really great, and we are starting to see the slowdown. Unfortunately, though, we probably shouldn't start celebrating yet, as we've seen from the US, from Europe, getting ourselves from 7 to 5 to even to 4. That was always the easy part. Getting ourselves from 4 back to 2. That's the bit that everyone's kind of sitting there going, oh, fuck, how long is that going to take? We're not quite sure of and where that's going, right? And so even under the current world, particularly where we're looking at with kind of oil prices kind of up to 85 and potentially higher, if we don't get some sense of normality in the Middle East, it is going to push up. I think going to be hard to get ourselves down to that 2%. Then we also look at some of these other things, right? So high house prices, that is stimulatory to the economy, no question on it, right? people feel richer, people will borrow, and I think that means there will be more money going into things. And then the second big one, which we can't forget about, is the tax. National have proposed tax cuts to a few lucky families, but interestingly, that's kind of going to add up to about 0.8% of GDP.
Yeah.
And so we that fundamentally, right, and they're not fully funded tax cuts. And so therefore that has to be stimulatory to the economy. So I kind of go, on balance, it's kind of hard to see us coming down anytime soon. And if anything, I see us in a world where kind of inflation probably remains stickier for longer, which means interest rates stay higher for longer.
But that's not a uniform, or I guess that's not a homogenous thing, right? Like when we think interest rates, we kind of just think interest rates are just one thing, but it's a curve. And we've seen a negative yield curve where it's more expensive on the short end. In other words, for short periods of time, the interest rate will be higher and you'll be actually getting a discount for longer term interest rates, which is really weird. And that usually is a recession indicator, or I guess it shows that a recession is coming, and it really only materializes when you see it inverting. And I've been wondering how this would play out, but now I kind of understand it a little bit with war and I guess the globalized problem of inflation, where it might not be so that the OCR, which affects floating interest rates all the way up to 12 to 18 months, really, it might not be that comes down. It might be that the longer term fixed rates go up. So we will have a positive yield curve after all, but only because the longer end is getting higher. Do you agree with that?
Yeah, look, the longer end is definitely getting higher. We've seen that, and in the US, the yield curve is flattening quite a lot, because where people are now going, hold on a sec, we're not sure there will be a recession. Because remember, as I'm pricing out my 10-year credit, I'm kind of going, every year I'm expecting what the interest rate is going to be the whole way through. So if I expect a recession next year and then interest rates to drop from 5.5 back to 2, then that kind of drives it. But I think now increasingly what everyone's starting to say is saying, maybe we were wrong on this recession. Maybe a soft landing is a possibility. And that's why we're seeing back end rates kind of continue to rise, because the projected time frame of dropping interest rates continues to fall. And that's also why here in the New Zealand market, over the last 3 days, we've seen 2 banks come out and increase their mortgage rates because their long-term rates are moving higher for them.
It's a funny thing, eh? It's like when you go on those rides where, like these thrill rides where you drop down, like these sudden death sort of drop rides, and there's like a little bit of a shudder, and it's like, oh, maybe it's going to be a soft landing after all. It's going to be a nice, gentle descent back to earth. And then right when you don't expect it is when it happens. And everything to do with the market always amuses me, because it always does stuff that surprises us. Nothing can ever be expected. And that's just human behavior. And
well, that's Bloomberg's point. So Bloomberg did a great article either last week or the week before talking about the narrative around soft landing is identical to the narrative that we had in 2007. Because they say the moment that everyone starts talking about a soft landing, that's when we need to worry about the hard landing.
And here we go, talking about a soft landing.
And I'm a little bit of a pessimist on a lot of things, but the truth is the only way, history has shown, the only real way that you can beat inflation is recession. Yeah. You've got to take a whole lot of demand out of the economy. And that's why I kind of go, on one hand, a recession is hard because people lose their jobs. A recession is ugly. It's really hard on people and businesses. But I'd say we have kind of 2 options here, right? We can either continue going down this path of trying to fight the recession and kind of doing just enough, but we got low growth, high inflation. We might be there for 4 or 5 years. Or alternatively, we go hard, we tip it into recession, and then we kind of 6 to 12 months of pain, and then we accelerate back out into the new cycle. We've got to do something to kickstart the next cycle.
Yeah, I think the Goldilocks zone is not the place. This isn't the time for the Goldilocks zone, because it needs to be just rip it off, right? Get on with it.
The Band-Aid's got to go.
Okay, so like thinking about KiwiSaver now, and again, we're kind of still around this New Zealand election piece, and I guess most people, when they're investing through KiwiSaver, they won't have it entirely invested in New Zealand. So the election will have some sort of result, but I guess in terms of what influences KiwiSaver performance at the moment, a lot of that is probably going to become dictated to by the global inflation story, which is going to be heavily influenced by the war story, in my view, anyway. But what are your thoughts? Like, do you think the election does have an impact on KiwiSaver performance here?
No, not at all. At the end of the day, most people have 20 to 30% of their KiwiSaver invested in New Zealand, the remainder offshore. The offshore dry, and even the New Zealand market, even that 20, 30% is largely driven by what happens offshore rather than what happens here. The two key things that are going to drive your KiwiSaver right now, one is what's happening with interest rates in the US. And we've kind of seen as interest rates are kind of the longer interest rates have risen over the last 3 or 4 days, we've seen equity markets fall pretty sharply. They're kind of down about 5% in the last week as a result of that. And then, of course, we've got to watch what's happening in the Middle East with Israel, Gaza as well, because that could be a major challenge to the global economy.
And to break that down just a little bit, so just thinking about the war in particular, so let's say the U.S. government needs to borrow a lot of money, right? Like they already do have to borrow a lot of money, but funding 2 wars now is going to be next level. So presumably that pushes up the interest rates and the bond prices go down. So there's a financial stability consideration there. And then there's a higher interest rate piece as well. So why would you want to put your money in risky equities when you have this, I have to use my air quotes again, risk-free rate of return with U.S. Treasuries, right? So is that kind of like the mechanism by which this all works?
Yeah, it kind of is, right? And I think that's the issue at the moment. I mean, on one hand, so the theory that you have said is 100% correct. The problem is what we've seen is as the US government continues to borrow and their borrowing demands are outlandish. I mean, they're running 10% GDP deficit at the moment. People still keep on giving them the money. And they don't have any problem borrowing. And so we haven't seen the risk premium or even the supply, I guess, demand premium, liquidity premium, grow, which is surprising a lot of people, right? And kind of as they keep on signing off and as they go, it just keeps on kind of working through. At the end of the day, though, right, $100 billion, which is what Biden has asked for the US economy, for Ukraine and Israel, that's nothing. Yeah. I mean, the US economy, it's kind of a $20 trillion economy. They're just, it's a rounding error in terms of the total spending in the US economy. So it's not much. It's the monetary side is not big. It's probably more the geopolitical side of it, where you go, can the defense industry sustain 2 wars?
And then there's the oil piece as well, which is
well, yeah, and that's the big risk on that whole region, and kind of one of the big things, right? And that's the reason why you have 2 US aircraft carriers in the Middle East right now, is to make sure that Iran doesn't do anything funny and disrupt the supply of oil. Like you've got the Strait of Hormuz. Well, I probably said that wrong, sorry, but that area, which is a very narrow piece of water, where I think, which kind of on the border of Iran, 40% of the world's oil supply goes through that narrow piece of water. That is why the US military is there, to protect that piece of water from anything that the Iranians might do.
And depending on who you believe, maybe they're there to help get their hostages out or other things, right? There's all sorts of conjecture around that. And that's what's so horrible about war, is that you don't really know what the whole story is. So it's like, how do you figure this out? But I guess as investors here in New Zealand, it's really easy to capitulate. I know I've had a few calls this week from people worrying quite a bit about what this means. And I think it's probably it's just as hard to be definitive that the scariness out there in the world means things go bad with performance and portfolios as it is the opposite. Like, you can't, I know these things are correlated and there's avenues by which inflation drives up things and changes the markets a little bit, but it's really hard to actually say that, hey, when things are scary, you should do X. You know what I mean? It's still somewhat random, isn't it?
Oh, massive. And well, look, at the start of this year, where every single market strategist and every single market person in the world said the recession was going to come. Sorry, not every single one. It's 95%. And most people had a forecast of the S&P dropping this year. Yet here we are, markets are up 15%. I mean, people struggle to believe me when I say the average KiwiSaver member is up 15, 20% this year. And it's kind of like, that's the bit that I keep on telling everyone. Over the last 4 years, what we've seen time in, time out, every time you think you know what's about to happen next, every time you make a call based on kind of some of the macro news, you get proven wrong.
That's right. Every time you try and outsmart the market, you're going to get your face ripped off. Someone told me that once. It's always true, isn't it?
Yeah.
Cool. Well, let's move on a little bit if we can. And there's been a lot happening in other parts of the world and in other parts of our portfolio if we do allocate in this space. So specifically digital assets and crypto broadly, Bitcoin specifically is what you can access. I know with your KiwiSaver provider provides access to Bitcoin. I'm down with Bitcoin, as I am a lot of asset classes. Every tool has a purpose in a portfolio, is my view. There's been a lot more happening here with Grayscale. So Grayscale, they have had a way that you could buy into Bitcoin without holding it directly for quite some time through a trust structure. They've applied to the SEC, the Securities and Exchange Commission. Correct me if any of this is wrong. I'm just reading my notes here.
Yeah.
And they were knocked back. And so it led to a bit of what they want to do is they want to apply to convert their trust into a spot ETF. There's a whole bunch of jargon in there, exchange traded fund. Do you want to talk me through just the history lesson there and where we're at with the battle?
Yeah. So the Grayscale fund is massive, right? It's like a $40 billion fund. It was the first retail mutual fund in the US to allow people to go into Bitcoin. And so very, very successful. For the last 3 or 4 years, they've been desperately trying to turn it into an exchange-traded fund. And one of the issues that they have, the reason they were so desperate to do this is the funds, when things are really good, the fund trades at a massive premium to the net asset value, right? And so in its simplistic terms, what that means is the fund has $100 worth of Bitcoin in it. When Bitcoin prices are rising and everyone wants in, it trades at like $105. And then when things are really bad, so like over the last couple of years, it'll trade at kind of a 20% discount. So you go into the Grayscale fund and you can spend $80 to buy $100 worth of Bitcoin. Under an ETF, the market maker structure means that there is always someone in the background which will normalize out those two things. So technically, an ETF will always trade and it will be delisted if it doesn't, but because it will always trade within kind of 0.5% or 1% of the underlying net asset value. So under the ETF structure, two things happen. One is you get rid of that premium discount issue because you've got market makers constantly buying and selling to sort that out. And then the second thing that you get is you open up the pool of investors that are able to kind of invest in this instrument, right? And over time, the SEC Securities and Exchange Commission in the US has consistently said, no way, we don't believe that this market is liquid enough and we think this market is ripe for disruption, which is why we are not going to approve a spot ETF. And so they've been fighting this for many, many, many years. They've had applications from Fidelity, BlackRock, Invesco, Grayscale. So many things have come across their desk, and every single one they kind of knocked back. Grayscale got sick of this, and so took them to court and said, look, we don't believe you've got the legal right to do that. We think you do need to assess this. We think you need to look at it properly. And the courts have agreed with them. And so now they will have to have a proper look at it. They will go through it. And so this has all happened in the last couple of weeks. At the same time, you've had BlackRock file all the paperwork needed for their own ETF, Bitcoin ETF. They've also gone and registered the ETF. They've set up clearing for the ETF. They've done everything necessary. That means the moment that an SEC kind of filing comes, within days, they can just go, bang, we're good, and we can get started in this. And I think, and also there have been rumors in the market that BlackRock have already started buying Bitcoin to seed into their fund. And so I think everyone's going, okay, this is real this time. This is going to drive a whole lot more demand into this product. a lot of the people doing like what we're doing right now. There'll be a lot more institutions getting into it. There'll be a lot more private investors getting into it. I mean, we were talking about it yesterday in the office. Some of my colleagues sitting there going, fuck, I want to do Bitcoin. I want to do it. I just can't trust myself with the wallet. The wallet is still a massive impediment to a lot of people. And this structure removes that impediment. And so I think there's a lot of excitement that if this gets across the ground, then this will drive the next kind of series of adoption and investment in the space, which kind of gets us one step further to crypto becoming a mainstream asset class.
Which is cool. And you've labeled those some of the reasons why I think it will be bullish, or it will be quite good news for Bitcoin as an asset price, because it just means that there's almost like an infinite supply of fiat money, or just regular dollars, that is being introduced really efficiently to the finite supply of Bitcoin. So it's like that irresistible force and immovable object debate that I'm sure you have in your head occasionally when you can't sleep, and that only really points to an upward trajectory in price. And I think that from an advisor perspective, when I'm talking to people about Bitcoin, sadly, it's usually when the market is just on a tear and things are going up. And when things aren't, people are just like, no, I'd rather wait for the price to triple before I buy in, which is crazy, but that's how people think. But even then, even when people want to do it, they don't, for the simple reason that it's the wallet issue. They don't want to have to fiddle around with seed phrases and learn the technology. And then they don't want to trust themselves, because if they make a mistake, they've heard all the horror stories. So this basically solves that problem. Obviously, you lose that use of Bitcoin as a monetary asset, as a medium of exchange. You lose that with an ETF. But I don't think the majority of investors are actually participating in Bitcoin for that reason. They're doing it for a fiat currency gain, right? Yeah.
And I think the big thing you've got to also remember around it, the supply and demand, kind of, we talked about supply and demand for housing. The truth is the crypto market is tiny. I mean, the crypto market in its totality is somewhere between $1 to $1.5 trillion. Let's put that in perspective, right? Apple's worth $3 trillion. And in that crypto market, the majority of it's Bitcoin, where they build, kind of, people talk about the fact that 2/3 of Bitcoin is tied up in a small number of people as well. So there is, that's why this thing, when it does go, it will go far, because there just isn't enough supply.
Yeah, exactly. And would you say, like, in terms of the typical portfolio that you see, the typical portfolio with Kōura, who have allocated towards a certain amount into Bitcoin, would you suggest that if they've had good performance this year, it's mostly due to having a little bit of Bitcoin? Because we're talking about something that's basically doubled in value this year. It's gone up by, like, I don't know, 20% in the last 7 days or so. So is that kind of the main driver into why a lot of the funds that you guys do has done well?
No, short answer. The truth is that the core equity markets have done really well this year. So we were looking at this last week. On a 1 year basis, kind of the average kind of Kiwi, not the average, but the average kind of equity holder for us has done up about 15, 20%. So it's a really good number on its own right. And I think that's the story that the media don't talk about, but equity markets offshore have done really, really well. And that's where our members have benefited. Those that have done super well are those that have put into crypto. I mean, our crypto fund is up kind of 70, 80% year to date. But it's a small number, but it has kind of, we do have people that are hitting 20, 25% returns because of that. But yeah, I think the big misnomer at the moment is the equity markets have done really well. So our core funds have done really well.
Okay, that's interesting. Okay. Before we move on from crypto in general, FTX, just giving us a bit of a lowdown on that. And I kind of caught up with the news last night. It feels kind of like everybody's turning on poor old SBF. Feels like maybe he was a bit of a dodgy guy after all. Who knew? But do you want to give us the lowdown on where we're at with Sam Bankman-Fried and FTX?
Yeah. And it's awesome, right? When you think about the parallels. On one hand, we've got in the New York courtroom that all of the issues with crypto and the crypto bros and how they ran their business is happening. on the other side of New York City, we've got kind of BlackRock and Fidelity fighting it out over who can be first in terms of the ETFs. And I just find it amazing where you've got those two stories coming together, right? A lot of people in the crypto world were very nervous about FTX trial and what it would expose in terms of some of the issues. But actually, it's been great because we're actually seeing a very different story and a very different side of that. But back to kind of what's been happening. Look, it seems as though he just ran that thing like an absolute fiefdom, which is fine. That's kind of what a lot of kind of people like that do. He kind of was telling people to put in exits to make sure that Alameda was able to do whatever it wants, taking client funds, unlimited credit limits. It's going to be really hard to see how he walks away from this. At the end of the day, what he told people, what he told investors is clearly a long way from what was happening. And it's kind of his CTO who testified last week has made that very, very, very clear. And I think with Caroline Ellison, we've seen that as well. So clearly a lot of it was down to his decisions and some of the things that he did. The flip side is it's going to be interesting to see. What is really interesting, though, which came out in the last couple of days, is there are 3 or 4 people vying to buy FTX as a business. So I think it's kind of almost, that's why I say there's this amazing paradox in the industry happening, going right. In October, November last year, FTX was the death of crypto. Whereas actually we've already, what are we now, October, 11 months later, and we're already kind of we've already come out the other side of that. We've seen the titans of Wall Street look to pick up the carcasses. And I wouldn't be surprised if the buyers of FTX are one of those very reputable brokers, whether it be potentially Fidelity, Robinhood, someone like that. And I think this is absolutely amazing and awesome for the industry because it just shows another legitimization of where it's going.
What do you think about the timing of the BlackRock ETF, scooping up all those assets for their exchange traded fund potentially during that period of time? Pretty good timing, right?
Oh, look, great timing, right? I mean, and that's where it gets really interesting. I don't know how much they need to seed the fund, whether it be 30, 40, $50 million. But yeah, there's a high chance they make quite a lot of money.
Do you think BlackRock would be, I haven't checked into this, but would they be one of the contenders to scoop up FTX as well, do you think? They wouldn't go that far.
No. They don't own brokerages. They're a fund shop. And so I kind of struggle to see them getting there. But there's just not much.
Well, I hope, like, for all those that lost money, like, I hope there's some sort of resolution. Like, there was a lot lost through these platforms and through these exchanges. And I guess if nothing else, it just kind of reiterates the importance of, if you're going to be holding Bitcoin directly, you really do need to get your custody situation sorted out. So you do have to deal with a wallet situation, or hopefully soon you'll be able to get a spot ETF. We haven't really touched on this time, but we have before. The fact that there's a futures ETF, BITOs is the one that I'm thinking of. And it's not the same, right? Can you just give us like a quick reason why a spot Bitcoin ETF is going to be better than a futures-based ETF if it gets approved?
Yeah. Because look, so unfortunately, the transaction costs involved with futures, buying and selling futures are pretty big, right? So they're kind of anywhere between 1 to 1.5%. And so if you're rolling your futures, so that means you buy a future for 1 month forward and then you buy another one 1 month later, you're spending 1 and a bit percent every single time you do it. So that's what we call the roll costs. And what we've seen, we talked about this kind of almost 2 years ago when we launched, and we said, actually, we think that this thing will trade underneath the Bitcoin price by anywhere between 10, 15% because of those roll costs. And unfortunately, that's what's happened. So it's a very expensive way to own crypto. And I think increasingly, as this market normalizes, and as we go, okay, rather than getting 200% returns on owning crypto, you're kind of fighting for 10, 15, 20% returns. All of a sudden, everyone who used to say, well, who cares, 10% cost is nothing, or they said 5% cost is nothing, or 2% or 1%, it will get to that world where we're all going to start fighting for every 0.5%, which is a great news story because that means the industry is normalized.
And I guess that's kind of what it's normalized, and it has the opportunity to mature as well, which is good. Awesome. Well, we covered a lot of ground. I wasn't entirely sure that we could cover all that today. But
and I think we're probably pretty close to a half hour too. So
all right, well, let's call it a day, and we'll try again next week and have another one.
We'll come back next week. I've already got the 5 or 6 stories in my mind next week, and we'll have lots there. We haven't touched on the China stimulus yet, or high rates, and what does rates mean for equities. Yeah. There's a lot there. It's a great time to be obsessed with markets.
Awesome.
Right now.
All right. Well, thanks very much, Rupert. All right.
Thanks, Darcy.
See ya.
We'll speak next week.